The market has fallen by over 10% from the top in the last couple of months. I'm sure a lot of investors are now worried about what should they do, especially those new investors who have been investing in the last 18 months or so. Those investors who have not seen any kind of market fall are worried quite a lot. The one question that is popping up to their mind is, what should I do with my existing portfolio? Should I sell? Should I add more? Should I exit equity markets and all? These are very common questions. You will face these questions every time now and then. Therefore, in this video, I thought I would talk to you about the reasons for the market fall. What are the kind of action you should and you shouldn't take? Please watch the video till the end. There are three reasons why the markets have been falling in the last couple of months. The first reason being the Fed rate hike expectation. Now that we all know that Fed will be stopping and increasing their interest rates, we all believe that the fund flow to a lot of markets, emerging especially, will stop coming down, thereby pulling down the valuations of a lot of expensive markets. And that's one of the key reasons why the markets have been corrected ever since interest rate hike has been spoken about. The second reason for the market fall has been, everybody today knows that the new variant of virus. I'm sure everybody is also reading that the spread is high, but the hospitalization is low. But whatever is said and done, it may have the potential to affect the supply chain. It may have the situation where the countries can get into lockdown and therefore creating a lot of disruption. That's another reason why the markets are falling. The third reason primarily is the valuations. We all know that in the last couple of months or before that, the market valuation shot up significantly, leading to small pockets of bubble in few sectors. That's one of the reasons why when the fund flow is expected to come down, the bubble popped up, resulting in severe bit of correction in certain stocks and certain sectors. So these are the three primary reasons for the markets to come down. When the stock market goes down and the value of your portfolio decreases significantly, it is tempting to ask yourself or your advisor saying, hey, should I pull money out of the stock market? That's absolutely understandable, but most likely not the best course of action. Instead, you should perhaps be asking, what should I not do? The answer is simple: don't panic. Panic selling is often people's gut reaction when stocks are plunging and there is a drastic drop in the value of your portfolios. Now then you should be asking, what should I do then? To answer your question on what you should do, the first thing that you need to check is if your portfolio is rightly aligned to your risk profile. You need to check if you have the investment in the right set of asset classes. Is it diversified enough into the right asset classes, whether it is equity or debt or commodity or currency or real estate? Then you need to ask this question saying, have you invested into the right assets? Have you invested in the right quality of the assets? And are the assets giving you the right kind of return that you expected it out to be? If that is the case, then you don't need to really worry about the market fall. The second thing that you need to do is to ask this question: if your portfolio is diversified well across various market caps, do you have the right set of sectors in your portfolio? Have you invested in the right set of volume versus value growth? Have you invested into the right set of dividend yielding stocks or the growth stocks? Does it match to your risk profile again? So if you're diversified well enough, the markets will fall, but then the impact of the market fall may not really be substantial on your portfolio. If that doesn't give you sleepless nights, then you don't have to worry about the markets. And the third and the most important thing is, have you aligned the portfolio to the timelines of your goals? Have you made sure that you have not invested in equity if your goal is 1 year away, and if you have not invested in debt if your goal is 10 years away? If your goal is very close by, then it makes sense not to have too much money in equity, because the equity market, as you know, are subjected to severe bit of volatility. And if your goal is too far, then please make sure that your portfolio is well diversified into equity, primarily because your portfolio needs growth and inflation is the biggest risk to your portfolio. Now, if you feel that your timelines of your goals are matching with your portfolio, then I don't think you need to worry about the markets. Let me share with you an interesting data that we have done in the last few days. We have seen that the market falls have been curtailed these days. Between 2000 and 2010, the market used to fall by over 22% on average each year. While in this case, now between 2010 till now, the market fall has been restricted to close to about 12-13%. What that means is that people are believing and investing a lot of their money if the market falls. And therefore, the market fall may not really be sharp beyond a certain point. So don't try to bottom fish. If you feel the money that you're invested is not required for the next few years, then I think you should go ahead and invest into these kind of market conditions. But if you think that the goals are nearby, you should not invest into the markets. Good luck.